Welcome back to another episode of me trading smart, managing risk while learning how to trade effectively. Thank you again, Metashako, for the new intro. Guys, if you leave a comment on my YouTube video, I will respond to it. So feel free to drop a comment. I love connecting with people. I love teaching people. I love inspiring people. So let's get it going. And before we jump into this video, I want to mention my new Discord community. So I launched this last Sunday for the purpose of simply connecting with other traders, just building a safe space where we can all share our lessons, grow together, share analysis, connect with other people, whatever you want to call it. It's anything and everything. So if you're interested in that, the link is in my bio. It is absolutely free. I'm not charging anybody for this. Okay. I'm not a guru. Okay. I don't ever plan on becoming one. I will have a mentorship, but that's well in the future. So if you're interested in that, link is in the bio, and let's get started on today's video. So before I do anything, I want to read how I saw the market today and how I approached the market before 7 o'clock. So I start watching the market at 7 o'clock in the morning, New York Eastern Standard Time, because that's the start of the New York morning session. So here's my analysis. I'm going to read this off my journal. It's right here. Boom, paper tablet. Cool. The day is Friday, and yesterday's candle closes outside of the daily SIBI, failing to reach consequent encroachment, indicating weakness. This week has also been primarily one-sided, so we can expect TGIF a retracement back into the range, especially with the close outside of the daily SIBI. Pre-market, I would like to see responsiveness out of the bullish breaker, allow them to pump it into a premium, perhaps an 830 red folder, clear out the trail buy stops from yesterday, possibly trading back into the hourly SIBI, then draw towards the previous day low. I'm also monitoring how we trade around the daily SIBI, watching how we react to the low of it, once leaving it, and seeing if price can reach into consequent encroachment the daily premium wick. Going into 7 o'clock, I'd like to see a drop down initially, take out the sell side liquidity, then work towards the buy side liquidity above. Okay. Price is in this range, which could be the start of the next market maker model. I have to study what price reaches for next. Does it initially reach for the buy side or sell side? I'd like to see it reach for the buy side first. Okay. So those are my initial thoughts going into today. Now I'll start on the higher time frame. All right. Boom. Let's trade in the higher time frame. So I marked out TGIF, which is simply a 20 to 30% retracement back into the weekly range on Friday when we have a primarily one-sided move throughout the week, right? So we can see Monday, Tuesday, Wednesday, Thursday, all up close candles, open, low, high, close. Now we can see in yesterday's session how we trade up into, I'm just going to remove this. Don't think it's too necessary for the analysis today. We trade up into the daily sell side imbalance, buy side inefficiency, but look how we fall short of consequent encroachment and we close below it. So this is the same thing as it. You would treat this as the same if you were looking at a 1 minute time frame because the market is fractal. The daily time frame is literally going to show you the same price action, the same behavior as that 1 minute time frame. So if we see the market trade up into a SIBI, fail to reach consequent encroachment and close below it, what does that indicate? That is the algorithmic signature of weakness. So reading this reaction off the daily SIBI, and it is Friday, so we can anticipate a retracement back into the range, right? Back into the weekly range. I'm bearish today, and I'm looking for lower prices. I'm looking for a draw to the previous day low. Now we have this reaction on a daily SIBI, and we can also utilize this wick, right? That's a premium array. It's above the market price, so we can drop quadrants on that. And look what the high day forms today, right at the lower quadrant. Isn't that something? That's perfect. That's precision, and that is algorithmic. So, admittedly, I didn't have the quadrants on the chart at the time. Now, if I did, that would have helped my analysis a lot more going into 930 because initially I was looking for a rally higher. We didn't get that. We just displaced lower right at 930. But if I had quadrants, I would have been like, wow, look how the market is respecting that lower quadrant. Because if I drop to the lower time frame, you're going to be like, what? And I'm going to be like, yeah. Yeah. Look at that. This is a 1 minute time frame. Look where the body stops on a 1 minute time frame. That's not buying and selling pressure. That is algorithmic. Look where the body closes. This is the highest close in this entire daily range. And look where it stops. Right at the consequent encroachment of that premium wick on the daily chart. Okay. So using that intel, we can look for lower prices post 930. But I was able to catch a nice long spotting what I saw in the pre-market session. So at 7 o'clock in the morning, which is right here, what do I see? If I look at the London session, I see we have a very clean breaker formation. We can frame that off of the new day opening gap right here. So look how we're closing above it. What does that indicate? Strength. So we have a high or we have a low, a high, a lower low, and a higher high. Sorry. This is a bullish breaker, right? So that last up close candle is going to be your most sensitive point in the breaker. There you go. Now notice how price is accumulating inside of the bullish breaker. That is giving smart money opportunity to get long. Okay. So I have this clear intel from the London session that we have a smart money reversal down here. Now I notice this range. Notice how price is trading in this range. Boom, 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 boom. And if you paid attention to the analysis that I gave at the start of this video, I said initially I want to see price pump higher into a premium, knock out those trailed sell stops or trailed buy stops from the previous session, right? Because if you're short off this move, where are you going to trail your stop loss? You'd probably trail it here, maybe even here, seeing a triple top, right? If you're short from the previous day, or if you're short from here, or even short from here, where are you going to trail your buy stop? And it's going to be above these very, very clean highs. It's a triple top, right? That's a retail idea. The algorithm's going to attack that because it knows there's buy side liquidity above those highs. So you notice the market is ranging here. Okay. Now, if we think in terms of market maker models, what is the start of every move? Well, you have initially a perfect little box of price action. And we see that here. And notice how we trade higher. The market is not interested in taking the sell side liquidity, right? It runs for the buy side first. So without any other context, you could literally frame a bias based on how we treat this perfect little box of price action because we reach the buy side liquidity first. So what's next? The market's going to defer to the other side of the marketplace and take the sell side second. Reaches for the buy side first. Okay, perfect. It's going to go for the sell side next. Once it delivers to a terminus and once we see a smart money reversal. Okay. So dropping down to the lower time frame, we'll get into my first trade of the day. Executions. Okay, so finally I snapped like my 12 trade losing streak, which is fine. Okay, this is my second week live trading ICT concepts. So I've been studying for 3 months. This is my second week. Today was the end of my second week of trading live, actually pushing buttons. Before then, I was just watching the candles paint, just watching price action. But today, the bias was easy because initially I wanted the market to pump into a premium, knowing that the draw on liquidity was the previous day low based on what we see on the daily time frame, right? And here I see the start of a market maker sell model because look what the algorithm does at the 650 to 710 macro. So basically I was just letting the market tell me, what does it want to do first? Does it want to reach for the buy side first, or does it want to reach for the sell side first? Now, if you look during the macro, what does it do? Well, initially we drop down and boom, we see large up close candles. The algorithm begins spooling for buy side liquidity. So right away, this tells me that during the macro, the algorithm is repricing for buy side liquidity. So this tells me that it's not interested in these lows and it's going to save them for a later purpose, which it did, right? So during the macro, we trade higher, we put in higher highs, higher lows. You can clearly see that the order flow is bullish. I let the algorithm literally show me, what do you want to do? It starts spooling for buy side posts or during the macro. So I'm like, okay, cool. It wants buy side. Let me see if I can look for something to get in sync with that. On the 5-minute time frame, I noticed that we have this inefficiency in price. And notice how the candles close above it. So what does that indicate? Strength. And look what this candle does. This candle opens here, trades down, hammers the open price of this candle right here, which is also the start of the 650 to 710 macro. So another trader in the Discord revealed this to me today. Literally, every macro is a open high low close or open low high close. So in this case, it was an open low high close. And the open price right there, that's also the open price of the macro is also a time level. And you can extend that out in time and use that as well. So this order block, no, what he said was order blocks and breaker blocks are just masking that element of time. So this is an order block, right? But it's also the start of the macro. This candle right here is the start of the 650 to the 710 macro. So this is an important time level. If you extend that out in time, look how the market treats it. I hope I explained that well. It's kind of confusing, but the way he explained it to me, I was like, what? So if you want to learn what he was explaining, join the Discord and I'm sure you could ask him. But I can't really put it into words too well. At this point in time, I have to do more back testing to understand it more. This open price is the start of the macro though. Look how we treat it. Boom. And this is what? A propulsion block, because we have an order block formed off of the order block and the candles are closing above that 5-minute imbalance. So when this candle opens and trades higher, this is clearly indicating strength to me, noting this reaction and this reaction. Well, this forms the fair value gap, but this reaction, right? I don't know why I was talking about this candle. This candle forms the fair value gap. This candle trades down into it and closes above it, so that indicates strength. Now, once we violate the open price of this candle, that is an order block, right? So I was watching the market on a 5-minute time frame, open here, trade down into the 5-minute propulsion block, and that is where I got my long entry. So going back down to the 1-minute time frame, this is on the 1 minute. So here's that 5-minute propulsion block. And I notice we also have a breaker. Check that out. Low, high, lower low, higher high. So at this point, seeing the market drop down into that 5-minute imbalance, also a 1-minute imbalance, respecting both, and then trading higher, creating this breaker, the order flow is clearly bullish to me at this point. So a huge paradigm shift, a big lesson that I'm sure would help you all as well, is you don't have to get the lowest low or the highest high of the move, okay? I don't need to get in down here. I don't need to get in down here. I don't even need to get in at this low. Look where I get all the way up. Look where I get in at. It's all the way up here. Look where the move starts though. It's all the way down here. There's also an SMT at this low, so add that for confluence. But I don't need to get the lowest low, okay? I want it to be very, very clear and obvious what the market is reaching for, and just let me find something to simply get in sync with that. So I think I put too much pressure on myself trying to find where can I get in at literally the highest high, the high of the day, or the low of the day. And that's just unrealistic if you're a new developing trader, right? What we can do though is read the order flow, annotate it, find something that suggests that the market is clearly reaching for something, right? In this case, it's the buy side liquidity above these highs, and then get in sync with that. And that's all you have to do, okay? You don't need the lowest low. So that is a lesson that I learned this week that I think is definitely going to improve my trading, because after I see all this price action, reading the reaction here within the 1-minute imbalance, inside of that 5-minute imbalance, off of the open price of the macro, which is also an order block on the 5-minute time frame, it's clearly bullish, right? And we have another breaker. We have another change in the state delivery. We have an inversion fair value gap. We have a short-term low here inside of this fair value gap right here. So we take out this short-term high. And at this point, I'm like, okay, this thing is clearly bullish. Let me wait for a deeper discount. And I wrote down in my journal. Let me see. If we pierce this high, I could look to be long off an order block targeting the weekly sell side imbalance, buy side inefficiency low, or today's new day opening gap low. So what I wanted to do was buy the sell stops resting underneath this low into the order block. And there's my execution right there. So you can see that this is a fat down close candle, right? But I'm not getting scared, and I'm literally buying the market as it is moving lower. That is how smart money trades. So this trade was just beautiful, and I'm very proud of myself for this. This was the perfect way to get out of that rut, like a 12 trade losing streak. But I mean, it was so easy. It was so clear and obvious that the market was reaching for something, especially after the macro, right? Just boom, starts reaching for buy side liquidity. I know this is the start of a market maker sell model, because we're not interested in these lows at the time because the macro spools for buy side. So this tells me that this is going to use this at a later point in time. This move is going to reach for a higher time frame objective, which would be this high right here. And then we see a smart money reversal, and then it reaches into these lows later in the New York session. But this is before the 9:30 open. But I mean, this reaction is perfect. Look how we just 1-2 candles in that inversion fair value gap, and boom, immediately snap out of it. It's perfect. And I was aiming for a very low threshold objective, although you heard me read my what I was aiming for in my journal entry, which was the new day opening gap. But I'm learning and I'm practicing, so I want to aim for literally the lowest hanging fruit, which would be this high here. Now, obviously, it delivered to the farther target, but that's something that I have to grow into. And really, I could have even targeted this high as well, right? And that would have delivered for 70 handles. So, market maker models. Market maker models. That's basically how I caught this entire move. And then I let the algorithm tell me what does it want to reach for. And going into this entire session, I wanted to see the market initially get pumped into a premium so that we could take it lower, run the sell side here, target previous day low. So I had this annotated in my chart at the beginning of the session. This is what I was targeting for an objective, a downside objective. Now, initially, I wanted to see a reversal here because there were just so many converging PD arrays in this one area. The reason we did not trade back up to this imbalance is because we would want to see it stay open, okay? On the lower time frame, if we have imbalances left on the lower time frame, leaving a daily premium array, we would want to see them stay open because that would indicate weakness. Once the market leaves that higher time frame premium array, we don't want to see it come back to it. So that means we don't want to see this imbalance traded to. So initially, I wanted to see the market trade back up here, but I was studying, do we even come back to this imbalance at all, or do we just leave it open and we keep rolling lower? And we just left it open and kept rolling lower because once we leave that daily time frame premium array, we don't want to come back to it. So we want to see this stay open. And then post 9:30, we see accumulation. The market spends time above this pool of buy side liquidity, and this leads to the start of the sell side of the curve. This is a market maker sell model. Here's your original consolidation. We leave the primary sell side intact. We take the buy side first. We deliver to a terminus right here, external range liquidity, external relative to this dealing range right here, right? External range liquidity. Do we trade up into an inefficiency? Not really. We kind of color outside the lines, and all this is kind of back and forth. So if we drop down to a lower time frame, that's probably all a balanced price range. A lot of back and forth, right? So we trade up into that balanced price range on the lower time frame, drop back down to the 1, and notice how we spend time above that old high, right? So here's that old high. Now we want to see the market spend time above old highs or below old lows because that indicates accumulation. That is accumulation, in this case, of sell positions. The market is spending time in that pool of buy stops, okay? So we have willing buyers at a high price. Smart money is going to be the counterparty to those willing buyers and sell to them because you need a buyer and seller for every transaction, right? Boom, they match up. Smart money is selling above old highs. Retail, street money is buying above old highs. So there you go. We accumulate in this pool of buy side liquidity. Notice that reaction off the lower quadrant. Boom, large displacement during what? The macro. So again, the macro is tipping its hand, telling you what I'm going to do. Right at 850, boom, starts spooling for sell side liquidity. Okay, what does the algorithm want to do? Well, what did the macro do? It started spooling for sell side. Okay, it wants to go lower. There you go. Literally let the macro tell you what this thing wants to do. Now, it's not going to be a straight shot every time. Like, obviously, we initially started spooling for that sell side first and then came back up and did all this business in here. But look what this left. Very clean lows, intact, right? It's all attacked at 9:30. Now, today's price action was problematic because we had a very small opening range gap. Not only that, but it's a Friday. So we had an opening range gap of how many handles? Of 30 handles, and ideally we want to see an opening range gap of 75 handles or more. That would indicate good volatility. Today is Friday. We had an opening range gap of 30 handles, so that automatically is problematic, and you can tell these conditions are problematic because of how many times we revisit the first presented for value gap. So initially, here's my first short position. Now I had a silly mistake here twice. I sold short here, and when I was moving my stop loss, I was going to put my stop loss above the second candle high. I accidentally moved my take profit instead of my stop loss. And so they just took me right out of the trade here and here. You can see I bought below where I sold. So I'll insert a clip of my frustration with that right here. Okay, so obviously I was frustrated after that mistake. And then here was just me trying to be a part of the move after I made that frustrating mistake. So I kind of went on tilt a bit after making that really stupid mistake. And then I learned a lot about myself and how I respond in high resistance liquidity conditions. So, I mean, as traders, if you're a trader, you are the business, okay? And if you are the business, you have to know when are market conditions likely to hurt you? When are you likely to hurt yourself, right? And if we have a small opening range gap, well, right away, we can tell that the morning session is probably going to be problematic. It's probably going to be a limp opening, and we're probably going to see high resistance liquidity conditions. The draw on liquidity was easy and obvious and clear. It just had a really, really, really hard time getting there. Now, in a perfect world, we would have just traded right up into the first presented for value gap and boom, shot straight lower for that sell side liquidity, right? But given that we had a small opening range gap, and look how many times we revisited the first presented fair value gap. Once, twice, three times, colored outside the lines. And notice how when we trade up into it here and trade lower, we don't even take out this short-term low. So the market is just having a really, really difficult time reaching for the liquidity below the marketplace. So you have to be able to recognize these conditions. And the sooner you can spot them, then the better you'll be, because you'll be able to save your own ass and know this is a day where it is very likely that I'll hurt myself. So I'm either going to just demo trade it, or I'm just going to tape read it, or I'm not even going to look at the charts. And then you can come back later at the end of the session feeling rewarded because you know everybody else was out here trying to make something out of these conditions and they hurt themselves and they stopped out and they lost money. Meanwhile, you didn't even have the charts on. You weren't even looking at it. So that was a huge lesson that I learned today. We have a small opening range gap. So that is the first way we can identify that these conditions are probably going to be problematic. And we have, look how many times we revisit the first presented fair value gap, right? So normally we'd want to see inefficiencies act like a rocket fuel. We want to see them spin 1 to 2 candles in it. We want to see it trade into it and then boom, immediately leave it, like right here. But we didn't get that reaction. We didn't even take this low, and we came back, touched it again, traded lower off it again, okay? Then we revisited it again. So I made the mistake twice here. Now, at this point in time, if we just leave all this off the charts, right, it's not clear that the market is in high resistance liquidity conditions. So we came back up, revisited it, closed it below. So I was selling short into this wick. We traded back up into this wick and I sold short again. Seeing this, we closed way below it, right? So that's literally the algorithmic signature that we want to see, but this didn't go anywhere. And I would have stopped out on this because I made the silly mistake here. So then I wanted to get in sync with that move, kind of an impulsive short here, but really in a perfect world or a regular market condition, this would have played out. So that was a good way to get involved since I made a mistake here, but these conditions were just not it. And then here I was buying those buy stops, or I was selling those buy stops above these relative equal highs one more time into the first presented fair value gap. And then we just had such a hard time reaching into that sell side liquidity below underneath the original consolidation from the market maker sell model. And then it reaches up one more time, knocks out the trailed buy stops, knocks out shorts, and then it makes its move. But I mean, look at the price action, right? It's hideous. It's just up and down. It's back and forth. It moves in your favor and then boom, jumps right against you. So if you're an inexperienced trader like me, this can really, really scare you and probably knock you out of a short early. And it knocked me out of a short early. So maybe if you're trading these conditions, you want to have a wider stop loss, right? A 30 handle stop loss or something like that. And maybe just a wider target because we know that it's reaching from down here. That's clear. That's obvious. That's easy. So that's it. I learned a lot today about high resistance liquidity conditions. Hopefully I could transpose my lessons down to you, and hopefully you can internalize them as well and prevent yourself from hurting yourself in these conditions if you're an inexperienced trader like me. And don't hurt yourself. All right, see ya.